All right, so what we are going to cover here is a little cheat sheet that I have in place in regards to acronyms when you're looking to get into the business. This is on an overall real estate, mortgages, and things like that. A lot of different acronyms that you guys are going to remember for the last 3 days of you guys taking this test that you've had to know, right? And please do your best to stop me if I'm going too fast. I'm going to really spit out a lot of different things that I want you guys to remember from each of these acronyms. Okay. And they're alphabetical order. So we'll start with the first one. AFBA means Affiliated Business Arrangement Disclosure. So again, it's the acronym, right? It's the root word, A, Affiliated Business Arrangement Disclosure. What do we think of when we think of affiliation, right? Who wants to take a guess? What do we think of when we say affiliation?
It's a partnership between person A and B with compensation involved.
I love it. Perfect, right? A partnership, a relationship, due diligence in between, but whatever it is, right? But they're somehow related. Now, if I'm a consumer, I should probably know that, right? I should probably know 99% of the times an attorney simultaneously also has an ownership or a partnership stake with a title company, right? That's usually where it is. Or a real estate realtor may have a partnership with a title company, with a survey, inspector, appraisal, whatever it is. Now, what is the percentage that must be disclosed based on that percentage? Who remembers? So what's the percentage of ownership?
Was it 1%?
Very good. 1%. The lowest possible percentage, right, Jose? 1%. You can't have, well, I guess you could have 0.5%, but 1% is the lowest that someone can have an affiliation. Do not confuse it with 25%. A lot of students sometimes get that answer wrong. 25% is what you disclose based on self-employment, right? If you have to disclose the income. 1% is your affiliated business arrangement. If you own 1% of a business and you're being in that transaction, then you must disclose it, okay? The next thing, American Land Title Association, that's just an ALTA. That's usually something that just breaks down all the fees for the buyer and the seller. So it's different than the loan estimate. The loan estimate is just the buyer and their mortgage, right, breakdown, or it used to be called the GFE, the good faith estimate. The ALTA is generally what is the final amount that the seller is looking to pay. What did they pay? What did the buyer pay for the house? And it breaks it down like that. So it's called the ALTA. The next thing you guys have is something called APR, annual percentage rate. It is the total amount for the entire length of the loan of the percentage rate. Your APR for a client is generally higher than their interest rate because it's based off of the total amount financed plus closing costs in regards to percentage points. Okay. In our mortgage, you guys probably also took this, right? If you guys remember, also known as adjustable rate mortgages. This was very, very common after the market crash, right? Some of you guys yourselves, or maybe even your parents, may have actually elected to take an ARM mortgage because, guys, at one point, interest rates were 13%. 14% to buy a house, right? Sometimes even 16%, I heard, right? That's crazy, right? I've seen them personally at like 6%, 7%, 5.625. I actually got my mortgage in 2016 from one of my houses at 5.625. And it was like, it was normal, right? Now I just bought my second home and my interest rate is 2.9. So literally almost half, right? And I've seen some crazy ones like within interest rates, different conversation for a different time, but interest rates are slowly starting to taper up a little bit. But they're nowhere near 6%, 7%, 14% of where they were. Okay. So consumers used to get adjustable rate mortgages because what's the first rate? Who remembers that they give you? What is it called?
That it's easier.
Very good, right? What do we do So keeping HR involved, right? When we want something, but we're not giving them the full thing, what do you do to somebody, right? You tease them, right? You're teased. You're like, hey, this is what you get. You're not getting the whole package, but this is what you get. So you tease them. So it's called a teaser rate, right? So you start off with the teaser rate, and then obviously as it goes, depending on your index and your margin, your rate goes up. And then you have what's called a cap, ceiling, meaning cap. You can't go higher than that, right? And then you also have the opportunity, remember guys, conversion, which just basically means that you can convert from fixed from an ARM to a fix, depending on the time frame of what that specific conversion ratio is. CD, guys, closing disclosure. Again, closing disclosure, this is the exact breakdown of what your closing costs, interest rate, your amount finance, your proposed mortgage payment. Everybody here remembers, right? It's almost synonymous to how the loan estimate looks. It's just a lot more detailed in regards to, or more accurate, I should say, in regards to how the fees actually end up being. CFPB, Consumer Financial Protection Bureau. Definitely want you guys to remember the CFPB. They're the big dogs, right? I call them. They're the ones that their job is to make sure that all banks, and they protect who? They protect, it's right there in the word, consumers. They protect consumers to make sure that there's no violations of any sort that is currently happening. So they make sure that specific timeframes, specific regulations are being followed by each respective bank and each respective institution. The CFPB consolidated, I think it's almost 12 to 15 different agencies, right, into one. And now they have a very, very firm control in regards to regulations in the market. Anybody have any questions on the couple that we just went through? We're good. I'm flying through them because I definitely want to go through this with you guys. So please stop me. CHARM. So going back to ARM mortgages, CHARM is the Consumer Handbook on Adjustable Rate Mortgages. That's something that must be given to the client when they're first initially disclosed. And it just gives them an idea of, hey, just a heads up, this is what you're getting yourself into in regards to what your rate's going to start out, what's going to increase, and so on and so forth. CLTV, guys, is combined loan to value, right? So LTV stands for loan to value. CLTV, if you have a first mortgage and a second mortgage, first LTV, second LTV divided by what the house is actually worth. COFI, 11th course, again, cost of funds index. You guys already know that based off an ARM. CRV, certificate of reasonable value. This you guys are going to see generally when an appraisal is given. It's a confirmation that this is what they assume the appraisal value is worth. You guys also remember for appraisals, there was 3 different types, right? Who remembers the 3 different types of an appraisal? Or I'm sorry, the three different types of approaches.
I remember one was cost.
Cost, very good. Cost is one. What else?
Was investment another?
So here, I'll go over with you guys. So cost is one. What's the cost to build the house? Self-explanatory. The next one, Jose, based on investment, they call it an income approach. How much money are you going to be receiving from that property? And those are usually based off of generally commercial properties, right? Because you have to calculate what is your net return, right? And there's specific calculations for that. And then you also have the most common one that appraisals use, and that we generally banks are obligated to more or less utilize, is called the sales comparison approach, which is basically, you guys might have heard this before. If you bought a house, you went through it, it's something called comps, right? Some of you guys, how many of us have heard comps, right? Comps just stands for comparables. So usually based on, again, they have specific appraisals is a whole different regulation, right? It's a complete, the appraisers have to go through classes and they have to do specific hours of training. And then there's different levels to appraisals, right? But usually from what I see is the appraiser takes that house, right? So 3 bedrooms, 2 bathroom homes in New Jersey, let's say in Woodbridge, right? So now what the appraiser is going to do is slowly start expanding the radius of the homes that are 3 bedrooms, 2 bathrooms, with say 2,500 square feet, and have a, if it's a modern kitchen, modern bathrooms, big amount of space, square footage, basement, garages, pool. All those things come into place. And then the appraiser, again, based on his discretion, right? And the supporting facts that he gives, usually most appraisers give anywhere from 5 to 6, sometimes even 3, 4 comps, right? Sometimes a home is unique and it gets a little bit more difficult, right? But usually sometimes that they'll go with the cost approach. But again, for the sales comparison approach. So sales comparison, cost, and income approach are the 3 different types. And usually they'll follow what's called the CRV, Certificate of Reasonable Value. DU, guys, DU is a big one. Desktop underwriting. Okay. Desktop underwriting is through Fannie Mae. Okay. So Fannie Mae is what? They're one of the secondary markets. They're the ones that set specific regulations and guidelines for banks to follow, right? So that's DU. ECOA, Equal Credit Opportunity Act. Remember, regulation B for B equal. Okay. So equal credit, ECOA, B equal. FACTA, guys, Fair and Accurate Transactions Act. What I want you guys to remember again is, what do we think of, Jose or Frank or one of you guys, what do we think of when we're thinking about accuracy and transactions? What usually comes to our mind? I know it's early, guys, come on. So what do we think of, right? We think of usually something being reported correctly, right? Now, if something's not being reported correctly and accurately, what does that mean might have happened? Someone stole your identity, right? So when you're thinking of the FACT Act, right, think of identity theft, okay? Identity theft and specific red flags that are in place to protect consumers from identity theft, okay? Fair and Accurate Credit Reporting Act. So what do we think of when we think of reporting? So regulation V is the FACT Act. And I want you guys to write this down. For V, think of verify. Okay. So verify for FCRA, right? The purpose of FCRA is things being reported correctly by verification, right? So again, now, how many people here, you hear credit repair companies and stuff like that. What do they do? Or what do you do yourself? You verify the information. If you think the information is wrong, what are you allowed to do? Right? What's that word? Begins with a D. Huh?
You can dispute whatever.
Dispute. That's it. Dispute. So you're allowed to dispute. FCRA gives you the right to dispute it. FCRA also gives you the right to ask for your credit score. FCRA also, banks must tell you the reason why you are denied, give you an adverse action notice. How many people here, when we were younger or were building our credit, applied for something and then you get a letter in the mail? It's usually, if I'm not mistaken, the timeline is 30 days, or they have to give you a decision, right? What do they say? Hey, congratulations, you've been approved. Or, hey, sorry, you've been denied. And the reason you were denied for is boom, 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 right? Length of history, too high utilization, bad credit, whatever it is, they have to do that because of the FCRA, okay? FEMA is a big one right now, guys. Hopefully, I hope none of you guys got affected recently by Hurricane Ida in New Jersey. You know, it was not fun. It definitely hit a lot of cities that usually you wouldn't think, right? Especially a lot of urban areas. And that was just because of, from what I hear, is sewage is just got crammed up or whatever it is. But FEMA, they're the Federal Emergency Management Agency. So when you want to check if a house is in what's called a flood zone, you have to go to the FEMA website, and they're the ones that also provide assistance if you've been affected. So for almost like a week, guys, because this just happened, right? A month ago. No, September 2nd, I think was the September 2nd or the 1st was the day it happened. It was a mess. I can tell you guys from my side, because obviously we own a mortgage company too. Every single appraisal that was conducted before the FEMA, before the disaster, we had to get what's called re-inspections. meaning the appraiser had to go back to the property and check to make sure the house wasn't affected. So it was horrible, right? But it's funny because at that time I was actually at a leadership conference too in California, and all the other branch managers that were in California and Florida were laughing at me because I was freaking out. You know, we went through this in Hurricane Sandy, but I was freaking out, and they're like, "Oh, dude, we deal with that all the time," which is true, right? Because they have wildfires, hurricanes, tornadoes, so they have the re-inspections are called 1004s all the time. And why were we forced to do it? Because almost a week we got away with it. We were forced to do it because FEMA came in under Governor Murphy and Joe Biden, and they basically said, hey, this county is being declared as a FEMA emergency relief county, where consumers or people who are affected can actually go to FEMA and ask for assistance. Since that happened, we were obligated as lenders throughout the nation to now have to do re-inspections. Okay, so that's just a quick little tutorial for you guys and the impact that it has. FHA, how many of us have heard FHA, right? FHA, Federal Housing Administration, right? What's the benefits of an FHA loan? 3.5% down payment. Credit scores don't have to be picture perfect, right? They can be as low as 580. You have the opportunity to also be able to finance 96.5%. You guys also get what's called MIP, right? Mortgage insurance premium, right? Remember, when can you guys, if you have an FHA loan, when are you allowed to cancel mortgage insurance? Anybody remember?
I know it's 78% automatic and then 80%. Well, once you hit LTV of 80%, you can go.
So now, remember when I was giving you guys the tips to the class, and I don't know if your instructor went through this, but remember I said, read the question? I'm not trying to bust your chops, but there's a reason why I ask this trick question every single time I do the instruction. FHA, mortgage insurance, is forever. So make sure you guys remember that. And if you didn't remember that based on your instruction, remember it now. FHA, mortgage insurance, is forever. The loan is being sponsored through the Department of Housing. They're going to make sure you have mortgage insurance forever. All right, guys, make sure you guys remember that. Again, I can't tell you 100%, but it may or may not be on your exam. Okay, so FHA loan, mortgage insurance, is forever. It's also known as MIP. Do not confuse it with PMI, which we're going to go cover in conventional, and it's just like Jose said, with 78 automatic and 80% request. Also, you guys have Freddie Mac, Federal Home Loan Mortgage Corporation. Again, that automated system, they call it LP, Loan Prospector. Same thing. There's specific guidelines. There's some guidelines that may not go under DU. Fannie Mae may not pick it up, but LP may pick it up. You take a look at that. And then we just covered Fannie Mae, right? Fannie Mae, like I said, is a secondary market. They're one of the largest secondary market holders, where lenders have the ability to take a loan and sell it on the secondary market to another bank. No difference to the consumer. I have clients all the time. Personally, me, when I bought my house, the second home, I originally got it with Bank A. Not even 30 days later, I get a letter from a bank that I already bank with, and it's a large bank. And they're like, hey, just a heads up, we bought your mortgage. It was sold to us through Fannie Mae, and we're now the mortgage company. We service the loan. To me, though, my interest rate stayed the same. My term stayed the same. No changes. My escrow did not change. Instead of me paying Bank A, I now just have to change my routing number and pay Bank B. Okay, so why do you guys think Fannie and Freddie is around? Banks obviously have a certain capital, right? 500 million, billion, whatever it is, in money, warehouse lines of credit and stuff. If I sell one loan to Jose, one loan to Frank, one loan to Nelvis, and all my money is gone, I don't have money to lend. But Jose can I could sell Jose's loan on the secondary market. I gave him 100,000. I could sell it, let's say, again, hypothetically, for a servicing transfer fee of 115. And if I sell it for 115, I just made 15, and I now have a free $100,000. So I have the ability to sell it again and to somebody else. Okay. FTC, guys, Federal Trade Commission. self-explanatory, right? Who the FTC is. We all know what they do in regards to do not call lists and all that fun stuff. Good faith estimate, I just covered it, also known as the loan estimate. The loan estimate, again, gives you the breakdown of your fees. I'm going to kind of go through these fairly quickly because a lot of these are easier. Gramm-Leach-Bliley Act, okay? So I want you guys to remember, these were 3 senators that came together. And remember, there were safeguard rules that were put in place. So I want you guys to understand that when you have safeguards in place, there's an acronym called SPF. And I want you guys to remember that. Who here remembers what were the 3 safeguards that were put in place for the GLB Act? Anybody remember? Your instructor remind you guys? No? No worries. That's why I'm here. So what do we think of when we think of SPF? How many here like going down the shore, right? When we go down the shore, right, and you have fair skin like me, what do we put? The sunblock, right? I read your lips, Jose. You put sunblock. You put sunblock. Sunblock has what? Sunblock has SPF to protect us, right? So this thing, SPF, guys, I want you to remember the safeguards, okay? So S stands for safeguards. P stands for pretexting. And F stands for financial privacy. Alrighty? Safeguards, pretexting, financial privacy are the 3 things that I want you guys to remember in regards to GLB. All right. And then you guys have something called Ginnie Mae. So Ginnie Mae is a government national mortgage association. They're the ones where the mortgages all get pooled. Okay, so Ginnie Mae is where mortgages get pooled. Freddie sells, and Fannie also sells and buys. GSE, government-sponsored entities, we just went through that. Government-sponsored entities, Fannie, Freddie, Ginnie. Make sure you guys remember, don't just remember Fannie, Freddie, Ginnie. Make sure you remember Fannie stands for Federal National Mortgage Association. Ginnie stands for Government National Mortgage Association. And Freddie, and exactly what each one stands for, guys. Federal Home Loan Mortgage Corporation. Super, super important because it may come to you in 3 different ways. HELOC is a home equity line of credit. Anybody here who's had a mortgage, HELOCs are what come in place if you're looking to just, I kind of call it like a credit card, right? A HELOC, substantial line of credit that you put against the house. Some banks have certain restrictions where you can't be obviously maxing out the whole house at 96.5% and get a HELOC. Probably may or may not qualify depending on the bank. HER, housing expense ratio, front end ratio, right? Everybody here remembers conventional loan, FHA loan, USDA loan, VA loan. Remember, front end ratio is what? That's only your mortgage payment divided by your income. Okay, so your front end ratio is your mortgage payment divided by your income. So conventional is, what's the front end ratio for conventional? 28%. What's the front end ratio for FHA? 31%. And then USDA and VA are both synonymous because you have reserves and you have certain money that you get. Okay, so remember that. HERA, Housing and Economic Recovery Act. Again, it's the reason why we're here, right? It's part of the SAFE Act. HMDA, Home Mortgage Disclosure Act. This one's also very important. The purpose of Home Mortgage Disclosure Act, HMDA, is to make sure banks are not being discriminatory. So banks have to ask specific questions and you have to disclose, did you get it on the telephone? Did you get it face-to-face? Did you get it over the email? You have to ask race, ethnicity, and gender. So for race, whatever your race is, ethnicity, whatever your ethnicity is, and then gender, again, male, female. If you do not know it, again, usually you're supposed to take your best educated guess or advise the clients to tell them to. HOPA, Home Ownership and Equity Protection Act. So I want you guys to remember this one. You guys remember with Julian, high cost and higher price loans, right? Remember the differences between the two. Higher price is just a little bit. So you have 1.5%, 2.5%, 3.5%. High cost, super, super high. So think of the differences of 6.5% and 8.5%. That's how I remember it. Higher, just a little bit. So 1.5 first lien, 2.5 for the second lien, 3.5 for a jumbo, or 2.5 for a jumbo, 3.5 for a second. And then high cost, 6.5 is the difference between a high cost from what the regular LIBOR is, and then 8.5 for the other. Homeowners Protection Act. This is where you come in, Jose, right? That's about mortgage insurance. So remember that, guys, mortgage insurance, this is the reason why you have the opportunity. You're protecting your home, right? You've reached that point. You've shown your commitment. HUD, again, Department of Housing and Urban Development. We already went over that, guys, in regards to what is protected, right, for FHA loans, right? HUD is sponsored the FHA loans. LIBOR, I just covered, right? London Interbank Offering Rate. That's what you go based off of in regards to adjustable rate mortgages, high cost and higher price mortgages. That's basically the benchmark, the offer rate. LP, guys, is the loan prospector, just like DU, but loan prospector is the automated system for Freddie Mac. DU is desktop underwriting automated system for Fannie Mae. LTV, again, is loan to value. What is your LTV? How much are you going to be financing? How much is the house valued worth versus how much are you paying for it, right? What's the appraisal versus it? Mortgage Disclosure Improvement Act, again, self-explanatory, disclosing in regards to what it is that you have going to be offered on the mortgage. MIP, we just covered mortgage insurance premium for FHA. MTA is the 10-year Treasury average yield index based on the cost of mortgage-backed securities in the Treasury yield. Nationwide mortgage licensing system and registry, the big ones, right? NMLS. They're the ones where your license is being reported. If you have any complaints, grievances, or anything against you, it is public knowledge. Your past experience. When you guys pass your exam, you have to give 10 years of past experience. All that information, who you worked for, reported on the NMLS, public data for you to go and get. PITI, you guys might have heard this say before, principal, interest, taxes, and insurance. A consumer, when they make their payment to the mortgage company, it's escrowed. They pay one payment. Principal, interest, taxes, and insurance. The mortgage company themselves services the loan, or they hire a third-party servicing company, and they distribute the money. Principal is the money you borrowed. Interest is the money they make. Taxes is taxes. And then insurance, again, 3 different types of insurances. Hazard insurance, Geico, Progressive, Liberty Mutual, Travelers. And then you also have flood insurance. Again, we went over if it's in a flood zone, and you have mortgage insurance if it's applicable. PMI, again, Jose, that's where you kicked in, right? 78 and 80%. Private mortgage insurance has nothing to do with the bank itself. They just hire third-party private mortgage insurance carriers. POC, you'll see it on the CD and the LE. Paid outside of closing means you already paid it in advance. A lot of the times, 2 things that clients can pay for in advance, the appraisal, and also sometimes the insurance, third-party professionals. Here's another one. What is one thing that a bank is allowed to charge a client before closing? Only one thing. The bank themselves. So don't overthink it. Think about it. Jose, you came to me, you want to apply for a mortgage, right? What's the first thing I need to know to get you qualified? How's your
credit report?
Very good. How's your credit? The credit report's going to tell me your debt, and the credit report's going to tell me your credit score. So credit report is the only thing a bank is allowed to charge upfront. Okay. And then a lot of banks usually don't charge them upfront. They charge them at the CD, the time of closing. Okay. SAFE Act, again, is we skipped a few. RESPA, Real Estate Settlement Procedures Act, probably one of the largest ones that we need to know. Regulation X for RESPA. Remember everything in regards to RESPA. It's all about making consumers better shoppers, right? So there's no surprises, okay? There's also certain restrictions, right? Kickbacks, can't have kickbacks. There needs to be annual escrow notices that should be going to consumers and all that stuff. SAFE Act, the reason why we're here, right? We're taking this exam because of the SAFE Act, right? Secure and Fair Enforcement for Mortgage Licensing Act. Obviously, in the past, one of the reasons why the market crashed, aside from supply and demand, was predatory lending. The SAFE Act now is supposed to protect us. Everybody here, you guys are all going through licensing requirements, right? And then remember, there's 2 different types of loan officers. You have a registered loan officer who works for a large bank and doesn't have to take this stuff. And then you have you guys who are going to be individually licensed through the state. A service release premium, again, if the loan is sold on the secondary market, the bank will pay a servicing release Truth in Lending Act, we went over briefly. So truthful, right? Truth in Lending, Regulation Z for Tilla the Godzilla. I picked up from one of the lady online. So Tilla, Regulation Z, right? Remember that. Super important. Advertising, anything of that nature. And then you guys remember, anybody here, 373 rule, right? Remember, 3 days after an application is taken, you have what? Loan estimate must go out. You're allowed to close in 7 days if possible, and 3 days that you must have the CD go out before you can actually formally close. Total obligations ratios is your back end ratio. So remember I told you guys your front end ratio was your mortgage payment divided by your income. Your back end ratio is your mortgage payment plus your debt that's reported on your credit, any government debt, any court ordered debt. Add those together and you divide them by your income. That's why they're a little bit higher, right? Conventional right now is what? 36%. FHA back end ratio 43%, and then obviously USDA and VA 41 and 43. Tilla RESPA integrated disclosure, I just said it, right? 373 rule. Did you remember that? TRID, it's also called. USDA, Department of Agriculture. A couple things I want you guys to remember for the USDA loan is allows you to put 0% down payment, but clients must pay a fee, right? Sometimes I believe it's about 1% currently in 2021 is what the fee that they must pay. Even if they're getting 0% down, they have to pay that fee. And in some instances, they have to pay a fee annually of like 0.35%. And then the big one is you must know the area median income, also known as AMI of the area. The area median income cannot exceed 115%. So Jose, if you make $200,000 and you want to move to, I don't know, give me a town, right? I did one USDA loan my entire career in Forked River, New Jersey, right? Which who knows where that is, right? It's actually not that far from me now. It's Ocean County, if I'm not mistaken, but it's pretty like agricultural farm, a lot of space, so on and so forth. The house was so cheap. It was about $100,000, $200,000. My clients were blue collar employees, right? And I say that as respectfully as possible, right? So you don't want somebody who makes $100,000, $200,000, $300,000 coming in and there's restrictions, right? So the restrictions in place is you cannot make more than 115% of the area median income. So let's say, for example, in this city, if the area median income is $100,000, the max that your client, if they want to get a USDA loan, can have is 115,000. If he makes 116, can't get it. If he makes 117, can't get it. So important. VA USDA, obviously, the least thing that we can do is give back to our veterans. So they give them the opportunity of a 0% down payment. They can finance it to 41%. But again, debt to income on these are a little less, right? They're 41%. And again, subject to each case by case, but it's usually 41%. You also have residual income comes into place. That's why there's only one DTI. And then the other thing too, is that there's also a fee. There's a fee that they have to pay. So make sure you guys remember what that fee is. If they put 0% down, off the top of my head, it's I think it's 2.3% is a variable funding fee that they call it. So make sure you guys remember that. They put 0% down and 5% down, it's 2.3. And then as you put more money down, it decreases. BOE, verification of employment. Guys, you'd be surprised, man. Today's day and age, some people are just like, you give me tax returns. Give me legit tax returns. Don't give me fake tax returns, because we're going to verify them through a 4506T. BOE, give me your real pay stubs, because thank you for giving them to me. I'm going to calculate your income, but I love you. You're my client, but I'm not going to just take your word for it, right? I have to verify it through verifications of employment. So usually it's a form. It's either done online through something called a work number if you work for a large bank or a large company, or you send it to the HR person and she fills it out. I've literally had people do fake BOEs and fake pay stubs, and we're like deep in the process. And I'm like, so now I'm like stuck between a rock, because I'm like, well, now I have to report you for mortgage fraud. And at the same time, it's like, dude, what did you like? And they're like legit pay stubs. And I'm like, dude. So again, regulations in place, which is one of the major reasons why I don't think, again, we're different conversation, right? Going into a market crash, because we're having eligible borrowers get a house, right? There's restrictions in place for DTIs. People are putting more money down. Consumers have higher credit scores, right? Less people are in foreclosures and forbearances, almost by 7 million right now because of COVID, than it was 10 years ago, or whenever the market crashed, 2008, when we had almost 7 million people going to forbearances and foreclosure. So different conversation, but VOM, same thing. Verification of mortgage. We want to make sure that if you have a current mortgage and you're buying another one, you're paid up to date, you haven't missed any payments, you made 12 consistent on-time payments to be eligible to refinance. We have to do verification of mortgages for that. All right. So about an hour, right? A lot of different acronyms that we just covered, but super, super important that you guys remember a lot of these acronyms because they may or may not come up on the exam. So let's get that. So